Calculating capital gains tax in Australia involves a few clear steps. In this video, I'll show you a straightforward guide you can follow whether you sell or otherwise dispose of a capital asset, such as shares, investments, property, or even some collectibles. The same basic process applies near to a year, so through thresholds and specific rules like indexation, it may change over time, but this guide assumes you're an individual taxpayer, not a company or a trust, and that the asset was acquired on or after 20th of September 1985, which is when CGT first came into effect. So first, to confirm that a CGT event occurred, it's an action, right? Any action that triggers a capital gain or capital loss. So common examples include selling shares, properties, or other investments, giving away, gifting, or transferring an asset. So, for example, between spouses, or receiving compensation or insurance payouts for the loss or destruction of a CGT asset. So, if you've sold or transferred an asset for money, that's most often a CGT event. So, just be aware that some personal use assets like your main family home may be exempt, but you'll still need to confirm that. And yeah, to determine your capital proceeds, proceeds is essentially the amount you've received or are taken to have received from the CGT event. In most sale scenarios, this is simply capital proceeds equal the sale price, so minus any selling costs if you choose to reduce proceeds by those fees, and if you paid a real estate agent or broker's commission when selling shares slash property, you can deduct those directly from your capital proceeds. And if you gave the asset away, so for example, as a gift, the capital proceeds may be the market value at the date of the transfer. So an example is you sell a block of shares for $10,000. Your broker charged $100 to sell. You can treat your capital proceeds as $9,900, for example, $10,000 less $100 brokerage. And to calculate your cost base, the cost base is what you originally paid for or cost to acquire the asset plus some additional costs associated with buying, holding, or selling it. Specifically, the cost base consists of purchase price, including any stamp duty or purchase fees, and the acquisition of costs of brokerage, legal fees, stamp duty, or transfer fees when you paid when acquiring it, or holding costs, because only some holding costs are included. Maintenance, interest, or insurance are generally not added to your cost base unless it's a depreciating asset. The main holding costs you can include are things like borrowing costs or investment property when it was being built, or certain legal valuation fees related directly to asset, and the improvement costs such as the capital improvement that add value like renovations to investment property, routine repairs, maintenance do not count. So just keep that in mind. And the disposable costs, so the brokerage or the agent's fees, legal fees, advertising for sale, and so on, all of these combined give you the total cost base. So if you held the asset for less than 12 months, this is simply your cost base for the CGT calculation. If you held it longer, you may be eligible for the 50% discount explained, which I'll show you, but it'll still start by calculating the full cost base. So, for example, you bought an investment property for $500,000, let's say, and then the stamp duty and legal fees when purchasing is $12,000, and then the renovation improvements capitalized is $30,000. And I'll just show you this demonstration, and then the agent selling fee when you later sell is roughly around $15,000, right? So then when you add all of this, your total cost base will be $15,000 plus $30,000 plus $12,000 and $500,000, right? Excuse my bad handwriting, right? And all of that equals $557,000. So if you didn't sell yet, excluding the selling fee for now, your cost base is $542,000. So to work out your capital gain or loss, capital proceeds from step 2 or cost base from step 3, you subtract the cost base from the capital proceeds. So essentially, it's the capital gain before discounts. So before discounts, right? Which equals the proceeds minus the cost base. So if the result is positive, then you have a capital gain. But if it's negative, you have a capital loss. So I'll just write this right here. Capital, I'll just say gain, loss. So you sold that property from example B, which for 650,000, right? And paid $15,000 selling cost. The capital proceeds would be $650,000. I'll just erase this right here. $650,000. Oh wow, that is, excuse me, sorry. I don't know why it's so. Okay, where $650,000 minus 15K, which is equal to 635K. So that would be the capital proceeds, the proceeds. And if I actually go a little bit right here and extend it out, then the base would be the 650,000 purchase. So I'll just write base right here. And then we'll do like a $500,000 purchase. And plus the stamp duty, which is 12K. And plus 30K. And that plus the $15,000 selling fee is equal to 557,000K. And the capital gain before any discount is $78,000. So say you sold your shares. Let me just erase this. Say you sold your shares for 8K, right? But you originally paid 10K for them. The capital proceeds are equal to $8,000, assuming no costs, and the cost base is $10,000. So the capital gain would actually be 8K minus 10K, which is actually negative $2K, which is a 2,000 capital gain loss. So that would be my example. If you enjoyed that video, I know that it might be complicated. Just rewind, look at the video again. Trust me, it took me a little bit to get just on this too. But yeah, hopefully you liked it. Like and subscribe for if you watched this video and enjoyed it. And I'll see you.